the FDAP income on guarantee fees. As per the US tax treaty, guarantee fees does not fall into any of the beneficial articles, and it has to be considered as other income. So other income is for other income payments being made, the withholding tax rate is 30%. So on guarantee fees, we do not get any beneficial treaty benefits. Then there are concepts of service fee, then maintenance of stock of goods. So you might have come across situations where the Indian companies are exporting goods to the US. They are just maintaining the stock of goods in the US for temporary period of time. So as you can see in the US India tax treaty, there is a concept, there is a wording, occasional delivery. So if you maintain stock of goods in US just for the purpose of occasional delivery, it is excluded from the definition of P, and the Indian entity is not considered to have a permanent establishment in the US. So this is a specific section in the US India tax treaty where it mentions about occasional delivery of goods. But if you are regularly storing goods in the US and storing inventory in the US, then it is important that you maintain sufficient documentation, or if it's and it should be through a third party in the US. If it's and you should also remunerate that party sufficiently to show that you are maintaining sufficient margin in the US for the activity. If you are conducting distribution activity in the US through a subsidiary or through a related party, then a proper transfer pricing documentation also has to be maintained, that to show that you are maintaining a proper margin in the US and you are not taking any benefit out of this. Then we have a specific fees for technical services in a clause in the India-US treaty. Then comes foreign tax credit. So for a branch model, a branch is taxed in the US at the normal rates of 35%, rather now 21% because of the new tax reforms. But this branch is a foreign corporation for US tax purposes, and while filing its return in the US, it will have, being a branch, it will have to include its US income also along with India tax return and tax it in US. So as per the US India treaty and as per the India domestic laws, a branch is allowed to take credit for those taxes paid in US in India. Similar situation is in US as well. Suppose the US entity has a branch in a foreign country. Similarly, that US entity is allowed to take credit for taxes paid in US. This was for the branch model. Then you may have a situation where the US entity may receive some payment from Indian entity for some services where the withholding has been made. So if it is determined by the various laws that this income was actually a foreign source income for US tax purposes, then based on the calculation that has been mentioned in the code sections, we can actually claim a credit for those taxes and avoid double taxation. The most important point over here is states' conformity to US India tax treaty. So as I explained in this point that maintenance of stock of goods for occasional delivery, it is excluded from being treated as permanent establishment for US tax purposes. That if you just go about reading the tax treaty, it says the treaty is between the federal government and the Indian government. There is no mention of the state government into this. The signing authority, the signing of the treaty is the federal government, IRS. So what about the states? Because the states have the different laws. Whether for federal we determine that it is not a PE, whether for states can be determined that you have a PE. So in this, the states have different laws, and they have conformity to federal laws, which says that suppose there is section 267, section 163J, whether that particular state conforms to that section or not. For example, NJ conforms to section 267. New York does not conform to section 267 of the federal code. So similarly, for permanent establishment, there are few states which do not conform to the the India-US tax treaty and the federal treatment based on the India-US tax treaty. So in this case, for federal purposes, we determine there is no permanent establishment, there is no filing requirement in the US. But the state will come and say that no, we don't agree to the India-US tax treaty, and you have a filing obligation in the US. So as an Indian entity, you are just exporting goods in the US. you have no other activity in the US, but still you will be required to file return in the US for state tax purposes, and you will have to pay taxes in the states. So this thing is something which very few companies are aware. People just focus on the federal obligations, and once federal obligation determined, then only they go on to the state obligation. But states taxation is a very critical part of US taxation. We had one of our clients who they were actually exporting goods from India to the US. They were not filing any returns in the US. They came to us. When they came to us, we started analyzing their returns, and we informed them that no, you need to file a return in the US. So for federal purposes, we file a protective return, which is a nil return, but a protective return, that in case the IRS, the tax department, comes to us, no, there was a requirement even at federal level, we will not be charged any penalties. So that is a protective filing which is made. And we suggested them to file returns in various states based on their activities. Also, in that case, they had no income. They had actually had losses from the US activity, but still they had to file return in the states. And in the state, there is a concept of minimum taxes. Like California has a minimum tax of $800. New York has $300. NJ has $500. So even if you have no loss, you have losses, you still have to pay taxes and pay minimum taxes in those states. There are some states like Texas which tax based on gross receipts. So we have one of our clients who are incurring millions of losses, but one of their customers, major customers, is in Texas. Since Texas is taxing on gross receipts, they are paying almost $57 of taxes in Texas, though they have no other income, no taxable income at federal level. Now everyone will be aware that Trump government has announced the tax reforms in the US which are applicable from the next financial year. This is a typical timeline of how the tax reform. This was just a 50-day process. The huge tax reform was just a 50-day process. September 27 was the date when they released the white paper on tax reform, and December 22 was when the President Trump signed the tax bill. You can see how fast this process has been, and the way it has even the consultants, all the major even the IRS officials, the Congress officials are still analyzing the implication of tax reform. Many of the provisions in the bill are actually still not clear to even consultants. And every day something new is coming up. You can see on November 2, one of the House bill was released. Then the Senate is they amended the House version of the bill. Then both the houses passed the bill. Then since both the House passed their own version of the bill, there was a conference committee being set up to bring a reconciliation between both the bills. That reconciliation happened on December 20. On December 20, and then President Trump signed the bill on December 22. Now in 2018, the first quarter has almost ended, but still we are awaiting the regulations on this tax reform. In US, the way it works is we have a code section, and then we have detailed regulations. So unless and until the regulations are out, the actual impact of each and every tax provision cannot be determined. So it is expected by the end of the second quarter that the IRS, the Internal Revenue Service, will bring out the regulations. These are some of the tax reforms that have been introduced. One of the most major and which everyone is talking about is the corporate tax rate being reduced from 35% to 21%. Then, as I explained, the interest deductibility restricts 30% of EBITDA and 30% of EBIT from after 5 years. Then, similar to the MAT, the minimum alternate tax in India, US also had alternate minimum tax for corporations, which worked basically that the regular taxable income that you derive, you are allowed 90% of the NOLs, the carryover losses against the regular taxable income. The remaining 10% of a taxable income is taxed on the rate of 20% as alternate minimum tax. But this has now been repealed from financial year 1890. Then the NOL, the net operating losses, which carryover losses are earlier were allowed to be carried over for a period of 20 years. But now it will be allowed to be carried over indefinitely. But the twist is that it will now be restricted to 80% of taxable income. So at any point of time, even if corporation has a huge NOL, they will have to pay taxes on the remaining 20% of the taxable income. But this is a prospective amendment, which is for NOLs generated post financial year 18. So NOLs generated prior to that will be allowed to be carried over for 20 years and allowed to be offset entire taxable income. Then there is a concept of accelerated depreciation, which is already in place, which allows 50% of the entire cost of the property to be expensed off in the current year. It is for qualified property, but now as per the tax reforms, for the next 5 years, 100% depreciation is allowed in the first year itself. So the entire cost of the asset can be claimed as expense in the first year itself, which is a huge boost for the manufacturing sector in the US, and also for those who are thinking of manufacturing, setting up manufacturing facilities in the US. This is a huge boost and incentive for that, for those people. Then there are certain minor changes to the expenses, deductions, such. Then these are the major international tax reforms. Base erosion minimum tax. This is usually applicable only to the large corporates in the US with gross receipts of 500 million or more, which says that a foreign related party payments made from US to a foreign related party will be disallowed, and a separate mechanism for calculating a base erosion tax is worked out. And US is, like many other developed economies, moving towards participation exemption. So a US parented group having subsidiaries in foreign countries, now dividend distribution from foreign countries to US will be 100% exempt from tax. US already had such provision for domestic subsidiaries, where there was 100% deduction allowed. Then there is deduction for foreign deduction eligible income, which says that in case of exports of goods and services, special deduction is allowed to the tune of 37.5% of that income to the US entities. These are subpart F inclusions in case of foreign subsidiaries. This is the kind of deemed dividend that we have in India. Deemed dividend provisions of subpart F are included. Before I go to this merger and acquisition, some parts I just forgot to mention. On the basics of US tax. In US, we do not have a fixed tax year. We can choose our own tax year. An entity can choose a tax year as July to June, September to August, anything. The due date is 3.5 months from the end of the tax year. And you are also allowed extension of 6 months from that. So suppose in a fiscal year April to March, the actual due date is July 15. But with an extension, you actually file tax return till Jan 15 of the next financial year.
Charge the interest also for that?
So I'll come to that. So when we take extension, we have to actually pay the tax liability, what we expect. So extension is for just for filing of tax return, but for payment of tax liability, you have to pay, as in India, estimate taxes we have to pay in four installments, and then by the time of claiming extension, we have to pay any tax liability which we not paid at the time of estimate taxes, we have to pay additionally. So interest they charge. Answer the question, interest. But penalties they will not charge because it's not a late filing or late filing of tax return. So these are the types of acquisitions from a tax perspective that an entity can make in the US. Stock acquisition, asset acquisition, stock acquisition deemed as asset acquisition. The third type of action that I mentioned is one of the most important point in this. I am acquiring an entity. I'll acquire the share of that entity. So from legal perspective, it's a stock acquisition. But there are specific sections, 338, section 338G, 338H, which says that for tax purposes, you can actually treat this as a deemed asset acquisition. So how that actually works is, in case of an asset acquisition, what happens is you get whatever assets you acquire from the different other entity are actually considered on a fair value basis, and you can actually consider the cost of the assets and claim depreciation on the fair value of the assets, you also generate goodwill and intangibles. So for US tax purpose, just for information, goodwill is amortized over the period of 15 years. So you got a benefit, additional consideration that you paid as goodwill will be allowed as deduction for tax purposes over the period of 15 years only in case of asset acquisition. So you make a stock acquisition for legal purposes, but make an election and you can treat it as they get the benefits of an asset acquisition and claim amortization of that benefits. Obviously, there are certain conditions which you need to meet, but I am not going to details on specifics of those conditions as of now. Then the employee stock options. This is the most ignored area of when any Indian entity is having operations in the US. What happens in a typical stock option structure is that the A Limited, the Indian entity, has a wholly owned subsidiary BINC in the US, and BINC are the employees of BINC. The BINC has given the stock options, issued the stock options to the employees of BINC. The employees will receive the stock of A Limited. The employees are providing service to BINC, but the stock they receive will be of A Limited, the Indian entity, which is very normal in the scenario, employee stock option scenario, which happens because BINC is a wholly owned subsidiary, so they cannot issue the stock options. The Indian entity, being a listed entity, will issue their stocks to the employees. So what the companies ignore in this aspect or take lightly is, since they are the stock of the Indian entity, there are no implications in the US. But it is a very wrong notion that people have. There are huge tax implications in case of such structure of stock options, because employees are providing services in the US. The employer is the US entity. It's just that the A Limited, the Indian entity, is providing the stock option. The deeming fiction is that A Limited is issuing the employees stock options on behalf of BINC for services received by BINC from its employees. So this is one of the major implications. Then what usually we have seen in case of even listed entities, that the stock options are issued on the date of grant, the exercise price of the stock option is quite lower than the fair market value of the stock options, of the stock of the listed entity. So this might not be a problem from the Indian perspective, but from US perspective, there is a huge tax implication. There is a section called IRC for section 409A, which treats this kind of stock options as deferred compensation. And suppose the FMV of the stock on the listed entity on the date of when the stock options are granted is 50. The exercise price is $10. So what it says is, at the date of grant itself, you have given a compensation benefit to the employee to the tune of $40. So this is a deferred compensation, and it will in a normal scenario, the stock options would be taxed to the employee on the date of exercise, which is a scenario in India as well. In such a scenario, the stock options will be taxed to the employees on the date of vesting, and it will also be subject to additional 20% excise tax. It is a kind of penalty of this deferred compensation to the employees. So in the US, the highest individual taxation tax rate is 39%, which now is reduced to 37% for temporarily for 7-8 years. In case of this 409A implications, you pay suppose in the highest bracket you pay 39% as federal tax, another 6-7% as state tax, and another 20% as this penalty. So out of the compensation benefit you receive, almost 60 to 70% you pay to the government as taxes. Just because of one negligence that there is no implication, you ended up employees paying almost 70% of taxes to the government on that benefit. So this will ideally be of no benefit to the employees. It's given to the employees to motivate them, to keep them loyal to the company, but employees will just end up paying, just get 30% of this, the benefit to them. Then there are treaty considerations to it as well. Now someone will argue that since it is the stock option of the Indian entity, should it be taxed in India? Should it be taxed in US? obviously the Indian tax authorities will come and say, no, it should be taxed in India as well. So whether employees have to pay in India, US, both the jurisdictions. So here there are 2-3 case laws and with 2-3 different implications. Some say that it is ideally a compensation income only, and as per the India-US tax treaty, it is exempt from tax in India. Some will say it is taxed at other income, and taxes will be withheld in India, and then US may give the foreign tax credit to this. So these are the other scenarios. But in any case, the US will anyways give a credit for the taxes paid in India. So the employees are safeguarded against this. I think this was it from the US tax part. So if anyone of you all have any questions, we are ready to answer.
To have those companies ask for the W8 forms, that's number one. Second is for software services company, what is the exact W8 form? Because there is a whole lot of confusion in those W8 forms. Nobody belonging to the IT industry would be able to decipher as to what exactly is the correct one. So which is the correct one which actually should apply for a software services company? And the third question in that is it one single W8 form which needs to be prepared by the company, and the same would apply to many clients in the US, or for every client in the US there would be a separate W8 form which has to be submitted?
Okay. So to answer your question, first of all, W8 Ben, the W8 form is actually required for all the companies. When a US company is making payment to the foreign company, it has to ask from the foreign company the W8 form. So now, which form is applicable to you? Now there are two W8 forms which may be applicable to an Indian entity, is W8 Ben E and W8 ECI. W8 ECI means W8 effectively connected income. As I mentioned, a branch will have its income effectively connected to the US for its operations in the US. So suppose in a scenario that I am a US company, I am paying to a entity, suppose a foreign US branch of an Indian company. So that entity actually is a foreign company. So that entity has to give a W8, but it will give a W8 ECI, which will say that its income that I am paying income I am paying to that entity is ideally taxed in the US while it's filing its tax in the US, and will have to issue a W8 ECI.
Kavit, just to clarify, I am talking about no Indian companies presence over there. Okay, so it's a US client and Indian company which is offshoring.
Right. So I was coming to that. So in that scenario, an Indian company has to issue W8 Ben E. There is no other form applicable. It's W8 Ben E, and it is based on for each and every payment. Suppose you are receiving interest from a US entity. So for interest you have a separate W8 Ben. For royalty you have a separate W8 Ben. But suppose you have interest, suppose multiple 3 persons in US you are receiving interest payment, you can use the same W8 Benny and issue to them. That's fine. Because W8 Benny you just have your details. You don't have to put the details of the US payer. So you can as long as the payment or the details remain the same with the vendors, you can use the same W8 Ben. But it is advisable that you advisable from the US payers perspective that they confirm from the Indian recipient that the information that they've given in prior years remains the same for W8 Ben, or else there is an updation of the information they have to ask from them. The Indian recipient has to provide the updated form.
This is Akansha. So my question is related to transfer pricing policy that you discussed.
Sure.
So in your example you said if you earn 100, 30 is expenses, 2 you need to keep. So my question is regarding that too. Like, is it some sort of tax that is it something that we have to give to IRS? Is it something that
Right.
the company has to keep in reserve?
I'll explain to you.
What can we do further? Because like if year on year you keep collecting that too, what do you do after that?
Great, that's a great question. From that 2, you will pay the taxes. See, 30 is your cost out of 100. The 2 is, think of it as profit before taxes, on which you will apply the tax rate. Let's say the effective tax rate is 20%. So out of the 2, 0.4 goes and 1.6 remains in your books. as retained earnings. And you obviously, which means you have a cash flow in the books, that cash can be used for growing the business further. Or if you have a lot of cash accumulated over a lot of years, then you can dividend it out back to the Indian parent. If you don't need to keep the cash flow there, you can always bring the money back there. But remember, when you declare dividend, there's a dividend. In India, we have a dividend distribution tax. There we don't have a dividend distribution tax, we have a dividend withholding tax. You have to pay 15% withholding to the US government. In India, foreign dividends are not tax-free. So for the parent company, the money that comes, the 1.6 that comes out of 2, you have to offer it at normal corporate taxes at 30%. You'll get a 15% reduction as foreign tax credit for the withholding that US has kept, and the balance 15% you'll pay to the Indian government. So it is not a tax-free distribution of funds. So we normally recommend, ma'am, that don't declare dividends. There's no point in bringing that money back. Anyway, what you're leaving is just 2 out of 100. 98 to aapka वैसे भी it's with you. 30 is expensed out, you're still getting 68 back. Keep the 2, net of tax 1.6 for growth of your business. You will need money for marketing, you will need money for hiring people, for technology. It's a very minuscule amount that we're talking about. So we just keep reinvesting. That's a larger thing. If for whatever reason you have had a very long relationship in a business and the accumulated surplus is very large, that's the time you can think about maybe instead of bringing the money back, think about another international location, let's say UK or Europe. Don't go from India, go from US. So that's how you can reinvest the proceeds of the retained earnings over time.
Since we are a product company, what are the implications while we are setting up the company? That was one. The second was about immigration. Is there a kind of a visa that one of the promoters gets when they incorporate, let's say, an LLC or something? Because in some of the other countries, that facility is given.
You have the United States Trademarks and Patents Office, right? So you go to register your trademark with the United States Trademarks and Patent Office. It's a very simple online application. Okay? You have to attach the actual trademark in a specific format. You got to do a conflict check that there's nobody else with a similar name or a similar brand or a similar logo. By and large, your logo will always be unique. The name can be same. Now, if you, let's say Microsoft has got a global trademark in 180 countries, you will never get that name. But once you have a unique name in India and you can show a history of business conduct over a period of time, you will get your trademark in a pretty, they are pretty efficient. 3 to 6 months you should get the certificate issued. In fact, that's a recommendation for most businesses that are starting up. If your trademark is critical, if your brand is critical, and you are getting business because of your brand, one of the things that you do once you are formed and you're up and running is go to the US trademark office and register your trademark. You don't want that your success is taken away by somebody else. Okay? Your second question was on immigration. So US does not give an automatic visa just because you have incorporated, unlike UAE or other countries. So you go to apply for a visa. So there are 3 categories. There's an H, there's an L, and there's an EB5. So depending on what business you are conducting, what is the level of investments that you will do, how much money do you need, one can choose which visa will work for you. And then there are nuances of every visa in terms of how much time does it take for processing, how much, what is the validity of the visa, 1 year, 2 year, 3 year, 5 year. In EB5 it's a green card, so it's a lifetime thing once you remove the conditionality. So businessmen and entrepreneurs have 3 categories of visa that one can choose. H visa, L visa and EB5. But it's an application to be made, it doesn't come automatic with the company.
Hello, hi, my name is Chavez. My question is that our director is already in US on H1B visa. So what advantage would we get for the incorporation to US, because we are looking for an opportunity? And what would be the approximate or minimum cost, if you can tell us?
Sure. See, when he is already on an H1 visa, and if you don't have a company there, it means he's not working for your company. He's working in somebody else's company.
Yes, that's
right?
true.
So therefore, you're not really creating value for yourself. So a biggest advantage is when you have an India as a parent and a US subsidiary, and a subsidiary does the H1 for your director, you are now capturing value within the organization. So that's the biggest advantage. The current structure is really not in the organization. Yes. So if you have to attract investments, you have to grow your business, you want to work with partners, you cannot put on the marketing profile that is employed with your company. And when you are growing your business, you want to show US presence by people who can show a business card of the same brand of the same organization. So that's one way to think. When it comes to formation is not very expensive. We typically, there is a filing fee which ranges between $300 and $600. These are actual expenses that you incur to incorporate the company, buy the corporate kit, pay the first year resident registered agent fees. So between 300 and 600 across the state. Some states are in the higher of the range, some states are in the lower of the range. A lawyer or an accounting firm will charge $500 or $1,000 to incorporate a company as a professional fee, making sure all documentation is right. So really the formation is not very expensive. I would keep an annual budget of between $5,000 to $10,000 for compliances, for filing, for regulatory, reporting requirements both in US and India, and the overall cost of doing business when it comes to the legal side of it. Now, when it comes to business side of it, in fact, that's the larger goal. You should be always thinking from a budgeting point of view. That what should be my annual budget when I'm doing this business? So the budget will be driven by, do I need a physical office? Do I need people? Now, if you don't need people in physical office, then really the cost is very little. If you need a virtual office, you'll get it for $500, $300 a month, just an address. Sometimes you don't even need a virtual office. So really depends on what is your method of collection. Is there somebody, an individual there who's going to help you? So you can cut down costs and really do business in $10,000, $20,000 for the whole year and still have a US presence. But to grow is a different ballgame. Then you need the right set of people, you need the right ecosystem, and that's where you spend because you're going to get money. You're going to grow your business and have more revenue, just like you would do in India. So it's no different.
When you were giving your speech, you said that the company LLC doesn't pay the taxes, it is the individual partners of those companies who pay taxes. Now, if I'm one of those persons and I don't want to take that money, I want to keep it in that LLC company itself and then spend it from the company, still I will be liable for taxes.
So that's where Kavit said, you take a 882 election and you elect the LLC to be taxed as a corporation, a C corp. So then you are not paying tax at the individual level. The LLC pays the tax as a corporate, and then the rest of the money remains in the LLC.
There is a percentage difference between individual paying tax and the LLC or the C corp paying tax.
Yes, there is a difference between that. The LLC, if it will be taxed as C corp, it will be taxed at a flat rate of 21%. The individual will be taxed based on the slab, the highest slab rate being around 37%.
Thank you.
I'm sure this is going to be a very good event and has solved a lot of your queries, and probably you're going to see a lot of new LLCs and C corp in USA. And you can always contact KNAV for further questions. You can call them, you can send them an email, and they will be available for a preferred basis. Okay. Thank you all. Thank you very much.